Let me bring in Dhirendra Kumar. Dhirendra, thank you so much for joining us on the show like you always do. Our first question comes in from Jay Sangvi. Now, Jay has written in, Dhirendra, he wants to build a corpus for a wedding, to renovate his flat in the near term. He also wants to buy a car. He says all of his money that he's investing has about a 3 to 8 year horizon. So this is not a long-term horizon, which is why we've picked this question to answer. He tells us he's got the insurance cover, he's got the term plans and the emergency fund. He has PPF, real estate, gold and debt investments. He wants to get rid of some of his endowment policies, and he wants us to take a look at his equity mutual fund portfolio. So this is what he sent us. He has 35 lakh rupees that he's created over the last 3 years in a mutual fund portfolio, and he's broken it up into equity, large cap, small cap and mid cap for us. But his questions are simply this. He wants to consolidate these funds, Dhirendra, and he wants to know how often he should review them. So first, let's take a look at his large cap portfolio. Now, this is 30% of his total portfolio. He has SBI Blue Chip and the Mirae Asset Emerging Blue Chip funds. And if you remember that he has about a 3 to 8 year horizon, are these the best funds to have in his portfolio, Dhirendra?
Yes, these are among the best funds to have. But, I would like him to approach it a little differently. When he is looking at large caps, these two funds are not necessarily always large cap. In a time frame of 7-8 years, you will have, a long phase which will be very unfavorable for that segment. As we see right now, that large caps over the last few years have been very disappointing, and mid caps have done exceedingly well. So if one was invested in large caps and not in mid caps, then one will be disappointed. And the best way for an individual investor is to invest in a manner that he is not deprived of such big moves, and that is a multi-cap fund, that is a diversified equity fund, the fund which has the flexibility, and that is what he should target.
That's what he should target. His second list of funds, Dhirendra, is the Invesco Midcap Franklin India Primer ICICI Prudential Value Discovery. This is a slightly larger chunk of his portfolio. Would you recommend he continues these investments?
For most passive investors, it is desirable that you invest methodically, maintain your discipline of continuing your investment even in bad times, and choose a fund which has essential flexibility. So he has chosen excellent funds in respective category. The character of some of these funds will undergo a change, like the ICICI Prudential Value Discovery, which did undergo a radical change in its design and strategy. But he has chosen good funds. If it's disciplined, it should work very favorably. It should prove very rewarding. But basic principle to follow: be with flexible funds.
To be with flexible funds, that's the big takeaway for you, given especially your time horizon right now. 3 more funds, Dhirendra: SBI Small and Mid Cap, Franklin Small Indian Companies, the Reliance Small Cap. Now, are these flexible funds? Should he continue a 30% allocation to these funds, given the 3 to 8 year horizon that he has?
These funds are not of the flexible kind, but these are excellent small, funds, which and they could prove to be very disappointing in a bad market. But so far, they're on a good run.
Well, Dhirendra, he has a very interesting question, which I know a lot of our viewers at home will have as well. If he has 5 lakh rupees that he'd like to make as an investment, obviously we don't recommend doing a lump sum. What is the best way to tackle that? Do you recommend the systematic transfer plan? Is there any other option that's more efficient?
No, that's the only way to go. The key principle is that you should eliminate the possibility of catching a market high. Even an interim, even a market high which might linger for a few years, and that is very important for an individual investor, because once you catch a market high and invest a lump sum, if you invest 5 lakh rupees or 50 lakh rupees, it goes down by 15%, and you lose your sleep, take your money out at the inappropriate time, and never to come back to the market again. So the best way of, even at the cost of losing, an opportunity loss, I would suggest that every investor should spread his investment. Spread your investment over 3-4 years. And ignore the disappointment of missing out on a market, surge or whatever, because it's extremely important to develop a belief and eliminate, reduce your own anxiety level with such investment, which has to work for you for next 20-25 years.